Okay, welcome. So this is the second half of Chapter 3, which looks specifically at the capital and the labor markets. And so this is going to be a building block again in terms of the production function. And there's a couple key messages that we're going to get from this. Primarily, the idea is that we want to understand the link between the production function, how productive our inputs are, and ultimately what the owners of those inputs get out of the process. And so really that's just a fancy way of saying how much do our inputs into production, the owners of our inputs into production get paid. And that's the primary objective of this part of the chapter. And so if we look at from a very basic framework, we're going to answer this question by assuming a couple of basic assumptions. So first of all, we're assuming a representative firm. So when we talk about this production function, in some sense, we're talking about in a global and a macroeconomic scale, we're thinking about a representative firm producing all of these goods and services and hiring all the inputs to do it. Now, that's a little bit of a stretch in terms of the reality, but nonetheless, it gets us to some key important results that are pretty robust from this standpoint. So we're going to assume that this representative firm is sort of running the economy to be able to make some basic inferences from that. And so under this framework, first of all, the firm, this representative firm, they are going to choose the level of inputs into the production process in order to maximize profit. That's just a basic economic fundamental assumption. And so they're going to choose the level of capital and labor in order to maximize the amount of profits that this representative firm gets. And so the underlying assumptions behind that are such that, first of all, the representative firm is a so-called price taker, and so it's a perfectly competitive market. We think about this goes back to a very basic sort of long-run viewpoint, which again is the point of this chapter is taking a long-run view. And so we assume that this representative firm is a price taker in the sense that they operate under perfectly competitive assumptions, and so they can't charge outrageous prices. And then the second important point is that, again, we're thinking about this in the long run perspective. And so what that means is that prices and wages are perfectly flexible in the sense that given some shocks to the economy, then our long run perspective mandates or requires really that at the end of the day, prices and wages are going to adjust to our equilibrium level. And that's, again, just a standard long-run assumption. And so the way that we can get to this issue is for the firm, again, when we think of profit, that's essentially revenue minus cost, right? And so for the firm's revenue is just the price level. Again, we're not thinking about a specific price of a specific good. Here, the price in the macroeconomy is the price level, the average of all goods and services produced in the economy. So when we multiply that price level times the total amount of output produced, which is dictated by this production function, right? This expression here then becomes total revenue. And then total cost, well, that's just how much we pay our inputs into the production process. And so we have two inputs, capital, which we pay our capital owners a rental rate R, capital R, and we pay our workers the wage rate W, capital W. And so those two terms on the right-hand side are the total cost to produce those goods and services. And so, as I said before, capital R is the nominal rental price of capital, and W is the nominal wage rate we pay our workers. But like anything in economics, we don't really care about the nominal viewpoint, but we care about the real viewpoint. And so what we really care about are the real amount of profits in the economy, okay? And so the real amount of profit that this representative firm gets. So if we divide both sides of this upper equation up here by the price level, then that's going to give us our expression for real profits. So the right-hand side of this equation then becomes just our production function, right? The total amount of real output produced. And then minus this expression here times the amount of capital we employ minus W over P times the amount of labor that we employ, okay? So we're going to simplify this. Again, given our production function, that F thing, we know that that's just equal to the amount of output we produce, Y, right? And then we're going to represent this ratio of capital R over P, the nominal rental price of capital to the price level, as little rc. So that represents the real rental rate of capital, okay? So we multiply that by the capital level, and then similarly, we're going to write omega, or little w, as the real wage. So the nominal wage rate divided by the price level, okay? So real profits for the firm then, again, are just dictated by the total amount of real output produced. There's the real amount of the real amount of payments to owners of capital, and the real amount of payments to our workforce to produce those goods and services, okay? So it turns out, and I'm not going to go through the details of this, you can maximize your profits if you take this function right here. Again, you're choosing capital and labor in order to maximize profits. And so if you take the derivative of this with respect to capital and labor, and you set up this profit maximizing condition, what you're going to get is this profit maximizing condition is going to tell you that you should hire capital up to the point where the marginal product of capital is just equal to the real rental rate of capital. And you should also hire workers up to the point where the marginal product of labor is just equal to the real wage, okay? And so the interpretation of these profit maximizing conditions is such that, again, you're paying your owners of capital a certain amount, and so the intuition is simply that the amount that you're paying them is exactly equal to what you're getting out of the production process. Same for workers. You're paying your workers a real wage, little w, or omega, and you're paying them that wage, which is exactly enough to offset what you're getting out of them in the production process. Nothing more, nothing less, okay? So that's the intuition behind, excuse me, that's the intuition behind these two profit maximizing conditions. What we'll see, though, is that at the end of the day, the firms are going to end up hiring the total amount of labor and the total amount of capital that's dictated by this long-run notion of L bar and K bar, which we talked about in the previous lecture. But what we'll see, though, is that the prices of labor and the prices of capital are going to adjust to ensure that labor supply is equal to labor demand. Here, we're solely concerned with what is the demand for these inputs. What is the demand for capital and the demand for labor? And that's what these equations tell us. That dictates the demand for capital. That equation there dictates the demand for labor condition. Okay. So what does this mean? Well, again, if we think about the intuition behind this profit maximizing condition, the condition says firms are going to hire workers up to the point where the marginal product of labor is just equal to the real wage. Okay. Well, why does that have to be? Well, here's an example of why you can see this intuition. Suppose that the marginal product of labor were less than the real wage. So the intuition here is that the total amount of output you're getting from the production process from your labor force, the real production is less than what you're paying your workers. Okay? So in other words, your workforce isn't earning their money. They're not earning their keep. They're not efficient enough to be able to justify paying that wage. Now, let's assume for the minute that the wage is constant, it's fixed, and we can't change it. but what we can do is change the workforce. So it turns out that if we reduce our workforce, right, so the total amount of labor goes down, if you remember the production function and the way the production function looks, as we reduce our labor force, what happens to the marginal product of labor? Well, again, with diminishing marginal returns, as the labor force decreases, you move down and to the left on that production function. The slope of the production function gets steeper, and the steepness of that production function represents the marginal product of labor. And so as you reduce the amount of labor that your firms are hiring and employing, the marginal product of labor is going to go up. And so when labor force declines, on the margin, your workers become more productive, and that process of hiring and firing would presumably occur up until the point where the marginal product of labor is equal to the wage. Now, the firm would never, in this framework anyway, would never want to hire workers such that the wage would be more, or as it turns out, the wage would be less, for intuitive reasons. So this is the case where marginal product of labor starts out less than the real wage. Eventually, it's going to, because of incentive conditions for the firm in terms of their hiring, they're going to end up at the marginal product of labor equating to the wage. Okay, and so that's going to be through this adjustment of its workforce. Excuse me. Now, what if we were on the opposite end of that? So what if instead the marginal product of labor was greater than the real wage? So in this case, the idea here, the intuition is such that the workers that you're employing, they're producing more than what they're costing the firms. And so what that means is that the firms are actually making a profit by that gap between the marginal product of labor and their wage, right? The workers are producing a lot of output, but they're not getting paid in real terms very much relative to what they're producing. So if firms are making a lot of profit, then the way you make more profit is by hiring more workers. And so the firms are going to hire more workers. And when the amount of labor employed goes up, again, if you think about that production function, as we move up and to the right along the production function, the slope of that production function gets flatter because of diminishing marginal returns. And that means that the marginal product of labor goes down. So as we add workers, the marginal product of labor goes down, and it goes down until these two things are equated. And at that point, there's no incentive for the firm to hire more or hire less at that point because it's profit maximizing. If it continued to hire more, then we would end up at this situation here, in which case the firm would then be better off cutting back. So that's the intuition behind this profit maximizing condition. And so at the end of the day, as I said, these conditions, which I laid out right here, those conditions represent our labor demand and capital demand functions. Okay, so what does that mean? Well, here's our, again, this is our profit maximizing condition for labor. For capital, it's exactly analogous, right? Firms are going to hire up to the point where the marginal product of labor is exactly equal to the real wage. Okay, what that means, and if you go back to the previous video, our marginal product of labor, the expression for that is given by that. Excuse me. And so here, that's our labor demand right there. And so we can derive a labor demand function from this profit maximizing condition. And so if we do a couple of steps of math here, so all I did is multiply L from the bottom part of that left-hand side there over to the right and flip the wage from the right-hand side over to the left by dividing. And if we solve for L, again, this is our labor demand function that we're solving for as a function of everything else, then what we have is 0.7 A over W to the 1 over 0.3 power times K. Now, how did I get that? Well, if I take both sides, so we have that L to the 0.3 power there, we need to get rid of it. So if we take both sides of this equation to the 1 over 0.3 power, that exponent on the right-hand side, the L side, is going to disappear, and that's how we get this expression here. So that's our labor demand function, and given everything else that we know, we can plug it in and go from there. And so, again, when we think about this, we think about both A and K being exogenous, right? So total factor productivity is just dropped from the sky. If we assume that capital is just taken as given, then that's going to be another piece of the puzzle here. And so if you look at this labor demand equation, if capital is known and total factor productivity is known, then suddenly you have this relationship between the real wage and labor demand. So as the real wage goes up, the wage is in the denominator there. You can see that the amount of labor demanded is going to go down and vice versa. So you have an inverse relationship between labor demand and a real wage. Again, intuitively, if if the real wage goes up, holding productivity constant, firms are going to want to hire as much workers. Said another way, if productivity goes up, then firms would be justified by hiring more workers as long if the wage goes up and vice versa. Okay. Okay. So so given that, if we look at So given that, if we look at our labor market, this is what it looks like. As I said, oops. Sorry, this flipped. Okay. If we look at our labor market, you can see that that demand for labor is downward sloping. As the wage rate goes up, you can see that firms are going to want to hire less workers specifically because of that equation that we solved for in the previous slide. So there's this inverse relationship between labor demand, and that's sort of driven by, excuse me, it's sort of driven by this marginal product of labor in this equation, equating the real wage to marginal product, okay? Now, on the supply side, again, this is where the rubber hits the road, and this is where all of this sort of becomes trivial in some sense, is that at the end of the day, in the long run, we assume that both capital and labor are fixed or exogenous. So that means that it just drops from the sky. There's just a number in terms of how much of these inputs we have available to us. And so in the long run, in equilibrium, the supply of labor is going to be fixed, and it's going to be invariant to the real wage. It's just, here's the workforce, and that's how much you have, okay? As I said before, when we put our labor demand function together with our labor supply function, well, where those two things cross, that's going to be our equilibrium, and in particular, that's going to be our equilibrium real wage, okay? And so the usual mechanics of supply and demand work here in the sense that if for whatever reason the wage is stuck above equilibrium here, then what that means is that you have an excess supply of labor relative to how much firms want to employ. And so because supply is greater than demand, that bids down the price of labor, i.e. the wage. The wage falls, as you can see here, until equilibrium. Similarly, if you have a relatively low wage, firms want to hire a lot of workers because it's really cheap relative to productivity. But not a lot of workers are able, excuse me, to work, and so you have an excess demand of workers relative to how many are available to work. That bids up the price of labor and the wage rate rises. And so through these basic economic mechanics, we end up at this equilibrium real wage W. The labor market is exactly analogous, and so if we look at the capital market is exactly analogous to this in the sense that we have demand for capital through the profit maximizing condition I talked about earlier. We have a fixed supply of capital, which is just predetermined at some point in the future. And so given those factors, our equilibrium is going to be at that point E. And at that equilibrium, that's going to determine our equilibrium real rental rate of capital. That's, again, the amount that's paid to owners of capital in real terms. Okay, so the last part of this, and I promise I'm going to get to a point soon, is thinking about who gets paid and how workers get paid. And so if we go back to, if we go back to our board here, who gets paid what? Well, again, the important question here is to think about, well, how much our income, how much of our income, our production is our wage earners getting, and how much of that production and income are capital owners getting. And so, first of all, remember our workers' real income is given by little w times L, okay? And we know that profit maximizing firms are going to hire workers up to the point where the marginal product of labor is equal to the real wage. So given that assumption and the equilibrium result that we just saw, okay, let's buy that. So that means that workers' real income is going to be given by the marginal product of labor times the amount of labor employed. Okay. Now, if you go back to the previous video, we know that you can calculate an expression for the marginal product of labor from this Cobb-Douglas production function. And so it turns out that that expression for the marginal product of labor is given by 0.7 times Y over L. So that's the marginal product of labor from this Cobb-Douglas production function, and then we multiply that by L. So it's pretty easy to see that those things disappear, and what we're left with is this expression here. Now, what does this mean? Well, again, we started off by saying, well, what are workers' real income? And the end result that we get is that workers' real income is 0.7 times Y. So in other words, of the total amount of production or income that occurs in the economy, 70% of that is going to be generated and run through and be received by our workforce, the labor force. Okay, and specifically we think about this as owners of labor, which is ourselves. Okay. We can do the same thing in thinking about how much real income capital owners receive. Okay, and so again, that's going to be RC times K. If you recall, the RC is the real rental rate of capital. And in a profit maximizing condition, firms are going to be hiring capital up to the point where the real rental rate is equal to the marginal product. And so again, if we assume that's the case, then the real capital income by capital owners is going to be that expression there. And again, if you look back, you can see the expression for the marginal product of capital is given by 0.3 times Y over K. And then we multiply that by the level of capital. So in the same fashion here, those two things disappear. And what we're left with is 0.3 times y. And so the real amount of income that capital owners of capital earn in this case is 0.3 times y. And so you'll notice again that these two things here come from the exponent on that Cobb-Douglas production function. Here's our Cobb-Douglas production function. Y equals AK to the 0.3, L to the 0.3. So those exponents are an important driver of the ratio of income that goes to labor versus capital owners. And so more generally, the punchline of this is that productivity is going to be driving these results. So an important aspect of thinking about how much income earners get is really, it comes down to how productive they are in the production process, okay? And so another way to see this is that if we go back to the slides, then we can actually look at some data. And so if you look at measures of labor productivity, you can see that they're fairly, whoops, happened again, okay. If we look at measures of labor productivity, you can see that they're fairly closely correlated with increases and decreases in real wages. So the period from 59 to 73, there was a relatively high labor productivity growth rate, and real wages grew at a commensurate rate. There was a slowdown from 73 to 95, and so you can see that real wages, the growth rate of real wages fell as a result. And then from 95 to 2012 period, there was an increase again in labor productivity, and that resulted once again in an increase in real wages. Okay, so the punchline here is that productivity is an important part of thinking about wage growth when we're talking about labor. And to underscore the point, if we have, for instance, a negative supply shock, okay? Now, a negative supply shock could come from a variety of places, but for one thing, it could be because of, say, a decline in total factor productivity, right? So if we have a decline in total factor productivity, then what that means is that workers just can't, even if we have the same workforce, they're not going to be producing as much output, and therefore their labor productivity is going to be lower. And so that's going to result in a shift in the labor demand function. The end result, as you can see, the equilibrium real wage is going to fall, okay? Another way that we can get this same result is if we have a decline in the amount of capital, right? Again, capital and labor work together to produce output. And so if capital goes down, then workers are overall going to be less efficient at producing output, and therefore you would expect a shift in the demand curve to the left. That, again, is going to drive wages lower. And so both of these things have implications for changes in labor productivity, and that then ties into how much workers get paid. Higher labor productivity, higher wages, and vice versa. And we get a similar story with the capital stock. Again, if we have changes in total factor productivity or other factors which result in a negative supply shock, then capital market owners are going to get paid less as a result of that because the capital itself is less productive. So the punchline is twofold. So technology is important to economic growth, and that's what we saw in the first video as the main punchline. The second punchline here is that we looked at the capital and labor markets and looked at what drives those labor markets and drives equilibrium, and more importantly, looked at what drives the prices of our capital and labor in the long run. And so it comes down to this role of productivity and how productive these inputs are, and that's going to drive how much those inputs get paid. So higher labor growth, higher labor productivity is going to lead to higher real wage growth in the future. Thank you.